Hi everyone, I'm Basil Nilambra, tutor for financial reporting. In this video, I'm going to debrief section B part of FR pre-June 2024 mock exam. So in section B question, you will be provided with a case scenario and there will be 5 questions in each case scenario. There will be 3 such case scenarios. So 3 into 5, there will be 15 questions. It can be multiple choice questions or fill in the blanks question or choosing true or false, correct, incorrect sort of question. It can be both descriptive or narrative type of question as well as numerical type of question. So when you answer this section B, first read the scenario on the left-hand side to have a general understanding of the scenario. So this is question number 16, the first case scenario of section B of FR pre-June 2024 mock exam. Therma Energy Company operates in the energy and environment solutions sector. Currently, the company is constructing large power plant for its customers. These contracts are long-term in nature and take many years to complete, so performance obligations are satisfied over a period of time. So IFRS 15 revenue will be the applicable accounting standard. Therma Energy has 3 contracts in progress at 31st December X4, all began in the current year. So this is very important because the contracts have begun in the current year. So when you calculate revenue in SOPL, total contract price into percentage of completion minus revenue recognized in previous year, there is no previous year. The company uses input method to account for profit its power plant project for all contract. So we have learned that there are basically 2 types of method to calculate percentage of completion. So one is input method and the second one is output method. So the entity uses input method. So remember how to calculate percentage of completion in input method, cost to date divided by total cost. Now, answering the first question of the section B, that is 16th question, how should the contract asset or liability be recorded in statement of financial position of Therma Energy Company for contract 1 in accordance with IFRS 15 revenue from contract with customers. So they're asking contract asset or contract liability. So you have to know how to calculate contract asset. How do we calculate contract asset or liability? Revenue recognized to date minus amount invoiced less amount invoiced. And how will you calculate revenue recognized to date? Total contract price multiplied by percentage of completion. Total contract price multiplied by percentage of completion. How much is the total contract price of contract 1? Contract price is given 12,500 multiplied by percentage of completion. Now, percentage of completion is not given. As per input method, it is cost to date divided by total cost. So how much is cost to date of contract 1? It is given contract cost to date is 8,000 divided by total cost. Total cost is not given, but we have learned that total cost is cost to date plus cost to complete. So cost to date is given as 8,000 plus cost to complete 2,000 into 100. That is basically equal to cost to date 8,000 divided by total cost, contract cost to date plus cost to complete 8,000 plus 2,000. Total cost is 10,000 into 100. That is equal to 80%. So 12,500 total contract price multiplied by percentage of completion, 80 percentage equal to $10,000. So revenue recognized to date is $10,000 and less amount invoiced is given in the question. Amount billed and received to date with respect to contract one is 11,000. So minus 11,000. So revenue recognized to date 10,000 less amount invoiced 11,000. It is negative 1,000. So negative 1,000 means it's contract liability. So answer will be option B, $1,000 contract liability. So moving on to the next question. What amount of revenue should be recognized in statement of P&L of Therma Energy Company for contract 2 in accordance with IFRS 15 revenue from contract with customers? And be very careful with this. They're asking your answer in dollar thousands. So you have to answer in dollar thousands, and all the figures given in the question is dollar thousands. So how do you calculate revenue in SOPL? So revenue in SOPL is basically total contract price multiplied by percentage of completion minus revenue recognized in previous year or previous year. Remember, this contract was started, all the contract was started during the year, so there is no previous year. So it will be basically total contract price of second contract, which is $15,000 multiplied by percentage of completion. So again, we have to calculate percentage of completion. Input method, it is cost to date divided by total cost. Cost to date is given. Contract cost to date of contract 2 is 9,000 divided by total cost. Total cost is cost to date 9,000 plus total cost, estimated cost to complete. So 18,000. So 9,000 out of 18,000, that is equal to 50 percentage. So 15,000 into 50 percentage, that is equal to $7,500 is the answer. So $7,500. So 7,500. All the figures are in already in thousand. Now, in relation to contract 3, what amount should appear in statement of financial position of Therma Company as at 31st December X4 as per IFRS 15 revenue from contract with customers and IAS 37 provisions, contingent liability and contingent asset. So if you go through those options, you can see contract asset, contract liability, contract asset, and contract asset. That is IFRS 15. And they're also asking you about the provision. So most probably there could be a loss with respect to contract 3. So if you see this, you can see contract price is 11,500 and total cost is contract cost to date 6,000 plus cost to complete 6,000. So total cost is 12,000. So contract price is 11,500 and total cost is 6,000 plus 6,000, 12,000. So there is basically a loss of $500. So we have learned that this loss should be immediately recognized in profit and loss account. Remember that. Now, first, let's find out contract asset. So contract asset is revenue recognized to date less amount invoiced. How will you calculate revenue recognized to date? That is total contract price multiplied by percentage of completion. So how much is the total contract price? 11,500 multiplied by percentage of completion. So you can either prepare this percentage of completion using the format of input method cost to date divided by total cost multiplied by 100. Cost to date is given in the question. Contract cost to date is 6,000 divided by total cost. I'm just showing you how you have to get the total cost. It is cost to date plus cost to complete. Cost to date is given in the question. Contract cost to date is 6,000 plus cost to complete is also given in the question. That is again 6,000. So total cost will be 12,000. So percentage of completion is cost to date 6,000 divided by cost to total cost into 100. That is 50%. And this is actually pretty much simple as well. You don't have to calculate like this because cost to date is 6,000 and it requires another 6,000 to complete. That means 50% is complete. You can directly get that 11,500 into 50%. So revenue recognized to date is 11,500 into 50%. That is $5,750. Amount invoiced is given 5,500. So 5,750 minus amount invoiced 5,500 is 250. Since that amount is positive, it's contract asset 250. So the answer can be either option A, which says contract asset 250, or option C, which also say contract assets 250,000. Now the question is that how much is the amount of provision? Is it option A 500,000 or is it option B 250,000? Remember, we have just stated in the beginning of the question the total contract price is 11,500 and total cost is 12,000, 6,000 plus 6,000. So there's a loss of 500 which have to be immediately recognized in P&L. But we have to see how much of this amount is shown in P&L in current year. So SOPL of current year revenue is total contract price into percentage of completion 5,750 and cost to date is 6,000. So already in profit and loss account, the entity might have recognized a loss of 250, 5,750 minus cost 6,000. There is a loss of 250 already recognized. So the total loss to be recognized is 500,000. Out of that 250 is recognized. So a 250,000 more is to be recorded. So the answer will be contract asset 250,000 and provision of 250,000. Option C would be the answer. Moving on to the next question. Therma Energy's accountant is unsure about how to account for sale and repurchase agreement. Identify whether each of the following statement is true or false as per IFRS 15 revenue from contract with customers. If repurchase price is lesser than original price, the entity must account for repurchase contract as a financing arrangement. That is false. If the repurchase price is lesser than original selling price, that is lease. And if the repurchase price is more than the original selling price, then you have to account it as a financing arrangement. In the case, it's a lease. The next one, if the customer is unlikely to exercise its rights of obligating the company to repurchase the asset, The entity account for the contract as if it's a normal sale with a right to return. That is absolutely true. Next one. Energy is contemplating to change the way they measure the progress towards completion of the contract. The company would like to adopt the output method based on surveys report instead of existing input method. How will this change from input method to output method be accounted? So changing the method of percentage of completion is a change in accounting estimate, and change in accounting estimate will be applied with prospectively. So option D, it's a change in accounting estimate with prospective application. This is IAS 8, changes in accounting policy, accounting estimate, and prior period error. The next scenario is about lease. So please read the left-hand side. The following information related to question 21 to 25. The following data relates to KRC company for the years 20x3 and x4. So 2 years data is given in the question. The year ends 31st December. Contract 1. KRC started leasing a new machine on January X3, that is beginning of the financial year ending on December X3. The lease period is 5 years and rental of 500,000 is payable on 31st December every year. So it's a not short-term lease since the lease period is more than 1 year and the rental is payable at the end of the year. The useful life of the machine is estimated at 8 years and the present value of lease payment is 205,000 with an interest rate implicit in the lease 7%. Contract 2, KRC acquired 25 tablet. So tablets is an office equipment. So this is a low value lease. And this was on July X3. So not in the beginning of the year. It is during the year. So we'll have to time proportion in case of annual lease payment. The initial payment was 3,000 followed by 2 monthly lease payment of 6,000 each payable in arrear. Contract 3. KRC has been using a building for its admin office. Its carrying amount on 31st December X3 was 2.2 million. On January X4, it transferred the building for a finance company for a consideration of 2.5 million, which equal to its fair value on that date. KRC immediately leased it back for use. So it is sale and lease back for the next 4 years. The estimated useful life of the building is 8 years. The lease rental agreed to be paid in arrear on December each year is 500,000. The interest rate implicit in the lease is 8% and present value of lease rental is 1,656,000. The transfer satisfies the condition of sale. Now, why is it important? We have learned that if it satisfies the condition of sale, then a sale and leaseback should be recognized. If it doesn't transfer the condition of sale, then the cash proceeds receipt should be recognized as a financial liability, that is as a loan. But in this case, we can record a sale and leaseback because the transfer has satisfied the condition of sale as per IFRS 15. So basically, there is a not short-term lease, a low value lease, and a sale and leaseback. So read the first question, that is question number 21. Which of the following is deducted from the initial value of right of use asset according to IFRS 16? Amount of initial recognized lease liability, incentive received by the lease, initial direct cost, cost of removing or dismantling the underlying asset. That is pretty much straightforward. Incentive received. I hope you remember what are the items that we show in right of use asset. Right of use asset, normally there are 5 things. One is initial measurement of lease liability, that is present value of annual lease payment. Second one, minus incentive received. Third one, initial direct cost. Fourth one, any initial deposit, that is any amount paid before commencement of lease and present value of site restoration or dismantling or similar kind of expenses. So what should be deducted? That is straightforward, incentive received by the lessee. The second one is also a narrative question. Which of the following is not a condition to be satisfied for a contract to be leased? So for a contract to be leased, there are basically a few conditions. One of the condition is that there must be a identified asset. And second one, there must be a transfer of right of use asset from lessor to lessee. That means the lessee should have absolute control over the asset. So which of the following is not a condition? The lessee should obtain substantially all economic benefit from the use of asset. That's a condition to be a lease. The asset must be identified. It is also a condition. The lessee has the right to direct the use of asset. That is also a condition. So the fourth one will be not a condition. The contract must provide a right to buy the asset at fair value at the end of lease period. That is not a condition. There is no need for a right to buy the asset to be a lease contract. So option D is the answer. The next question, for the contract number 1, calculate the current lease liability to be recognized in the statement of financial position at 31st December 20x4. So they're asking current lease liability for contract 1. So how do you calculate the lease liability? Since the lease payment is in arrear at the end of the year, the current liability will be the difference between current year lease liability and next year lease liability. And you have to be very careful with the year end. They're asking 31st December X4 and the contract 1 was entered on January X3. So the first year ending will be December X3, second year ending is December X4. So they're asking second year current liability. So it will be the difference between 31st December X4 lease liability and 31st December X5, the next year lease liability. So let's start preparing the lease liability schedule. So lease liability, we start with on 1st January X3, initial lease liability. How do you recognize initial lease liability? It is basically based on present value of annual lease payment. So how much is the present value of annual lease payment given in the question? And they're asking us in dollar thousands. So 2050 or $2,050,000. The lease payment is made at the end of the year. So on 31st December X3 plus effective interest. Effective interest will be calculated on the lease liability, 2,050,000 multiplied by 7%. Using the calculators to find it out. So that is equal to 2,050,000 multiplied by 7%. That is 143,500. So 143,500,000. Now 31st December X3, at the end of the year, there will be less annual lease payment. Annual lease payment is made at every year end, and that is 500,000. So the lease liability on 31st December X3 is using calculators to find out the figure. It's 2,050,000 plus 143,500 minus 500,000, that is equal to 1,693,500. Then the next year, 31st December X4, again plus effective interest. Effective interest will be calculated on the above amount 1,693,500 multiplied by 7%. Multiplied by 7%, the effective interest is 118,545. Then on 31st December X4, at the end of the year, minus annual lease payment, that is again 500,000. So this would be plus 1,693,500 minus 500,000. That is the lease liability on 31st December X4 is 1,031,245. Next, it's not over. This is a lease liability as on 31st December X4. Now, what you have to do is that the current liability, they're asking about current liability on 31st December X4. The current liability will be the difference between this lease liability on 31st December X4 and next year lease liability. So we have to move one more year forward. So 31st December X5, the effective interest would be 1,312,000 or 45 into 7%. So that is equal to multiplied by 7%, 91,843. 91,843 is the effective interest, and on 31st December X5 at the end of the year minus annual lease payment. Annual lease payment is 500,000. So then you would get the lease liability on 31st December X5 So this is basically 1,312,000 or 45 plus effective interest 91,843 minus 500,000, that is equal to 903,888. So as discussed earlier, the current liability on 31st December X4 will be the difference between 1,031,200 or 45 minus next year lease liability 903,888. So the answer is equal to 1,312,000 or 45 minus 903,888 is equal to 408,157,000. So the current liability is 408,157,000. Now be very careful, they're asking you to round off to thousands. So it will be 408,000. Moving forward, for contract number 2, calculate the amount to be debited to statement of P&L for the year ended 31st December X3. So contract 2 KRC Accurate 25 tablet. So basically that's a low value lease. In case of a low value lease, the annual lease payment will be shown in profit and loss account. So how much is the annual lease payment? They have given 3,000 is the initial direct cost and followed by 2 monthly payment of 6,000 each. So the total lease payment total lease payment is equal to initial direct cost of 3,000 plus 6,000 plus 6,000. So total lease payment is 15,000. And this total lease payment is for a year, 6 monthly to 6 monthly. That means it's for 1 year. But if you see, we don't have 1 year in this case. The contract was entered on July and year end is December. So July, August, September, October, November, December, 6 months. So the annual lease payment, which will be shown in P&L, will have to be time proportioned 15,000 into 6 by 12. That is equal to 7,500. So the answer is 7,500. Next. For contract number 3, calculate right of use asset and profit and loss to be recognized on January X4. Now, you need to know sale and leaseback for this and how to calculate right of use asset in a sale and leaseback question. So in a sale and leaseback question, right of use asset is equal to carrying amount multiplied by lease liability minus difference between fair value and sale proceeds divided by fair value. You need to know this formula on how to calculate right of use asset in case of sale and leaseback. So how much is the carrying amount? The question has given the carrying amount on December X3 is 2.2 million. So that is 2.2 million. Since the question is asking in thousands, I'm taking thousands here also, 2,200 multiplied by lease liability. Lease liability is given. Lease liability is present value of lease payment. The present value of lease payment is given in the question 1,656,000. So 1,656 minus difference between fair value and sales proceeds. So in the question, they have stated that on January X4, it was transferred to a building to a the building to a finance company for a consideration of 2.5 million, which equals its fair value on that date. So the selling price and fair value is same. So there is no difference between fair value and selling price. And divided by fair value, the fair value is 2.5 million. It is transferred to a finance company for a consideration of 2.5 million, which equals to its fair value. So selling price and fair value is same, which is 2.5 million in thousands, 2,500. So use the calculators to find out the answer. So that is 2,200 multiplied by 1,656 divided by 2,500. That is equal to 1457.28. So since we are rounding it off, we can say 1457. So right of use asset is equal to 1457. 1457. Now they're asking to calculate profit or loss in case of sale and leaseback. Remember, profit or loss in case of sale and leaseback, you have to record the sale and the leaseback. So I hope you remember our class on sale and leaseback. How do we first we have to record the sale. So debit cash How much is the cash received? 2,500 in thousands. And credit asset. The asset is basically building, and the credit will be the carrying amount of the building. And carrying amount of the building is 2,200 in thousands. Now you have to record write-off use asset, debit write-off use asset, which we just found out. That is 1457. And credit lease liability, which is basically present value of lease payment, which is 1656. Now total the debit. So when you total the debit, it is 2,500 plus 1457. 2,500 plus 1457 is equal to 3957. And when you total the credit, that is 2,200 plus 1656, that is 3,856. There's a difference in the credit side. The difference in the credit side is basically profit. So how much is the difference? The debit is 3957 minus credit is 3,856 equal to 101,000. So profit or loss 101. Moving on to the next question. Now, this is the last scenario. The following information relate to question number 26 to 30. Facto has identified a cash generating unit which consists of the following asset on 1st July X3: machinery, other plant and equipment, land, technology, goodwill, current assets, and total carrying amount is 1,800. The company has recently suffered a considerable decline in its revenue due to new technology that has rendered the fact's existing technology completely obsolete. Considering the situation, an impairment review was undertaken on 1st October X3. The recoverable value of relevant cash generating unit is 1.4 million. And remember, the new technology has become completely obsolete. That means there is an asset damage. Which of the following asset require annual impairment review irrespective of whether there's any indication of impairment? That we have learned in the class. There are two assets that require annual impairment review. One, goodwill acquired in business combination, and an intangible asset with indefinite useful life. So option 1, goodwill acquired in business combination, and statement number 3, intangible asset with an indefinite useful life. So option 1, 1 and 3. Straightforward question. Again, a narrative-based question. Identify whether each of the following statements are true or false in accordance with IAS 36, impairment of asset. Inventory should not be written down due to impairment as it is already carried at a recoverable amount as per IAS 2. That is true. Inventory will be carried at cost or NRV, whichever is lower. So if NRV is lower, the asset will be shown as per IAS 2 NRV, the estimated selling price. You can also think like this. In case of impairment of asset of cash generating unit, we will allocate the impairment loss first to asset damage, second to goodwill, and third one to non-current asset on pro rata basis. So an impairment loss is never allocated to inventory as per IAS 36. So inventory should not be written down as per IAS 36 is true. As per IAS 2 also it is true. And the second one, the reversal of impairment loss should not take the value of an asset above its depreciated historical cost. That is again true. The reversal should be only up to the value of carrying amount if there is no impairment loss. Next, calculate the carrying amount of machinery after the cash generating unit impairment loss is allocated and the assets values are written in accordance with IAS 36 impairment of asset. machine in dollar thousands. So opening the Scratchpad to show the calculations. So the total carrying amount of CGU, cash generating unit, is 1,800 in thousands. The recoverable amount is 1.4 million, that is 1,400. So basically there is an impairment loss since recoverable amount is lower than carrying amount. So the impairment loss is a difference of 400. The impairment loss will be first allocated to asset damage, and there is technology that has been damaged. The carrying amount of the entire technology will have to be written off because it is obsolete. So 150 will be allocated to technology. Second will be allocated to goodwill, and goodwill is 150,000. So it will be allocated to goodwill. And third, the balance will be allocated to non-current asset on their pro rata basis. So how much is the balance? 100. Out of 400, we have allocated 150 to technology and 150 to goodwill. So there's a balance of 100. Now this balance will be allocated to non-current asset on pro rata basis. So what are the non-current assets there? We do have machinery having a value of 700, plant and equipment having a value of 500, and land having a value of 200. So total of all those non-current asset, machinery 700, plant and equipment 500, and land 200. So the total is 1,400. So the amount allocated to machine will be on this pro rata basis. So machine, the impairment loss allocated to machine is equal to the balance impairment loss is 100. It will be allocated to machine on its pro rata basis. Out of 1,400, 700 belongs to machine. So 100 into 700 by 1,400, that is 50. So the carrying amount of machine after impairment loss will be carrying amount of machine before impairment loss 700 minus impairment loss of 50 allocated, that will be 650. There are so many such questions available in your study hub, as well as there are so many past question paper. This is a very popular kind of question in your FR examination. So you should know how to allocate impairment loss of cash generating unit. Next one, calculate the depreciation on other plant and equipment with a carrying value of 464,000 for the year ended 30th June X4, given the remaining useful life of equipment as 4 years on the date of impairment review. So once an asset is impaired, then that asset will be recognized at its recoverable amount. So the recoverable amount of plant and equipment is given 464,000. And once an asset has been impaired, the depreciation will be calculated on recoverable amount over its remaining useful life of 4 years. And it's basically, we have to time proportion this because the impairment loss was undertaken on October X3. The year end is 30 June X4. So October, November, December, January, February, and March. April, May, June, 9 months. So multiplied by 9 by 12, that is equal to 87,000 is the depreciation of other plant and equipment. So 87. I'm just going to show you that calculation very quickly if you have not understood. I'm just going to use a Scratchpad. So once an asset is impaired, we have to depreciate that asset based on recoverable amount. recoverable amount is 464,000. The depreciation will be based on remaining useful life. Remaining useful life is 4 years. And the asset has been impaired on 1st October and the year end is on 30 June X4. So time proportionating from 1st October to 30 June X4, 9 by 12, you get 87,000. So moving forward to the last question. So on the right hand side, Fact company owns specialist plant bought 3 years ago, having estimated useful life of 10 years that has a carrying value of 1.05 million at 1st July X3. Cost is 1.5 million less accumulated depreciation for 50,000, depreciation being charged using straight line method. An impairment review was conducted at that date due to potential obsolescence of the plant and recoverable value was determined as 975,000. The impairment loss of 75,000 was recognized on 1st July X3. Subsequently, on 30 June X4, the situation improved, which meant the recoverable amount of plant was revised to 1 million. Meanwhile, the accountant has processed the entry for depreciation on 30 June X4. So there is a reversal of impairment loss. Reversal of impairment loss should be recognized as income in SOPL. But the reversal should not go more than the carrying amount if no impairment loss. So which of the following is correct accounting treatment with regard to plant owned by Fact company in accordance with IAS 36? So if you remember our class, I've told you reversal of impairment loss will be normally the difference between carrying amount after impairment loss and carrying amount if no impairment loss. So what is the carrying amount after impairment loss? They have given the carrying value is 1.05 million on 1st July X3. We have to calculate what is the carrying amount on 30 June X4. That is on the date of reversal of impairment. So on 1st July X3, once an asset is impaired, that asset will be recognized at its recoverable value. So the recoverable value is given 975,000. So the carrying amount after impairment loss will be its recoverable amount, that is 975,000. Now, once an asset is impaired, the depreciation will be calculated on the recoverable amount over the remaining useful life. So on 30 June 20X4, the depreciation will be recoverable amount 975,000 divided by remaining useful life. We have learned that remaining useful life is useful life 10 minus used life at the date of impairment. The impairment at the date of impairment, it is very clearly given that the cost is 1.5 million less accumulated depreciation of 450,000, depreciation charged on straight line method. And it is very clearly given that the asset was bought 3 years ago. So that means used life is 3. So useful life 10 minus used life 3, remaining useful life will be 7. So 975,000 divided by 7. Let's use a calculator to find out the value. So 975,000 divided by 7 equal to, that's a pretty much odd figure, 139,286. So the carrying amount after impairment loss based on recoverable amount over the remaining useful life is 975,000 minus 139,286. 286. That is 835,714. So we have got the carrying amount after impairment loss is 835,714. Reversal of impairment loss is a difference between carrying amount after impairment loss and carrying amount if no impairment loss. So you have to calculate what is the carrying amount if no impairment loss on 30th June 20x4. So they have given that the cost of the asset is 1.5 million and the asset was bought 3 years ago on July X3. So on 30 June X4 means we have to depreciate the asset for 4 years. So less accumulated depreciation for 4 years. So that will be 1.5 million divided by 10 years, that is 150,000 into 4 years, that is equal to 600,000. So accumulated depreciation is 600,000 and cost of the asset is 1.5 million. So the carrying amount as on 30th June X4 will be 900,000. So we got the figure. The reversal of impairment loss should not be more than carrying amount if no impairment loss. In other words, reversal of impairment loss is the difference between carrying amount after impairment loss 835,714 and carrying amount if no impairment loss. So that is equal to minus 900,000. So the difference is 64,286. Let's see how they're asking us. It's reversal of impairment loss of 64,000, rounding off to the nearest thousand. So that's it. I hope you have understood this particular debrief video. Thank you, everyone. All the best for your FR June 2024 exam. Goodbye.